Your bank is running a financial analysis on you right now. You're not allowed to see it. In the next 5 minutes, here is what it says, and here is how to run the same thing on your own numbers. I'm Dip Shaker, founder of DIY My Finances. This channel is about one thing: the financial intelligence that's been sitting on the institutional side of the table for decades, and what it looks like when you put it on yours. Your bank isn't just storing your transactions, it's interpreting them. Every 30 to 90 days, your financial behavior gets scored across 6 dimensions. Income stability: is your income regular or volatile? Balance trajectory: is your average balance trending up or down over 90 days? Debt to income ratio: what percentage of your income is already committed to debt? Savings rate versus your peer cohort, not a national average, people in your income band and life stage. Spending stress indicators: minimum payments, overdraft, rising utilization, and life stage classification. New parent, pre retirement, recent job change, inferred directly from your spending patterns. 6 dimensions running continuously. The question is what they do with it. The gap between what your bank knows about your finances and what you know, that gap has commercial value to them. Your balance has been declining for 3 months. You don't know that. Your app shows today's balance, not the trend. The bank sees it and adjusts your credit profile before you have noticed anything is shifting. Your debt to income moves into a risk zone. You find out when the mortgage rate comes back higher than expected. No explanation given. Your savings rate is 40% below your peer cohort. The bank offers you an investment product, not a savings conversation, a product. In each case, the institution acted on information you didn't have. This really isn't about bad intent, it's about how retail banking is structured. Balance declining for 90 days. What would help you is a savings plan. What typically gets triggered is a line of credit offer. Debt to income rising: a budget review would probably serve you. A personal loan, a pre approval arrives instead. Spending stress elevated: a financial wellness conversation would be appropriate. A balance transfer card shows up. Same signal, different outcome. The analysis exists to find the right moment for a product, not to prompt advice. Once you see that structure, you can't really unsee it. Three things shift when you have this visibility yourself. You act before the institution does. Know your debt to income is borderline 6 months before a mortgage application. You have time to fix it. Without visibility, you find out when the rate comes back. You see the trajectory before it becomes a crisis. A balance declining $200 a month is invisible day to day. Over 90 days, it becomes a pattern. Catching it early means a budget adjustment, not an overdraft. And product offers stop being surprises. You understand what signal triggered the offer. You evaluate it as a position buyer, not a marketing target. Here's what your banking app shows you: balance, transactions, credit score, and basic spending categories. And here's what the institutional model is running at the same time: 90-day balance trajectory, income stability score, debt to income, savings rate versus peers, spending stress, life stage, and all that gap is left by design. Your app shows you enough information to feel informed, not enough to negotiate. This is what AskFin returns on your own numbers. Built from uploaded statements, no bank linking is required. Savings rate negative 15.5%. Savings versus target. Spend versus peers 26% higher. Debt to income 26.7%. Cash flow lockup. Debt free timeline 25 years based on the current plan, and 6.7 years if you're optimizing it. That 18 years difference is what visibility is worth. Same 6 dimensions the institutional model tracks. Your numbers, plain language. Your numbers, not averages. Run this on your own numbers at diymyfinances.com. The link is in the descriptions. Takes about 4 minutes. See you in the next one.